Hello, thank you all for joining us today. We have a very wide range of companies on the webinar from many of the parts of the world, which I think probably reflects the huge interest there is in understanding the status of global climate policy and what that might mean for business and how we really start to deliver on the transformation of our economy that's required. My name is Rebecca Fay. I'm the Chief Marketing Officer at Natural Capital Partners, and I am here really just to introduce our speaker and to moderate the questions at the end. So I'm very pleased to introduce our presenter today, our very own Jonathan Shopley, who leads all our work on policy and external affairs. I'm not going to give long introductions, but suffice to say that Jonathan is a veteran of COP, and has spent many years putting the technical complexities of global climate change policy into language that is relevant for business. Before I hand over to Jonathan to start us off, I just have a couple of housekeeping points. We know everyone is very busy, so we are keeping this presentation to a concise 20 to 25 minutes with some time for questions at the end. And you will all be on mute, but please do post any questions you have in the box on the right hand of your screen, the right hand side of your screen, and we'll go through as many as we can at the end in the last 5 minutes. To kick us off, before Jonathan starts, we'd like to start with a poll. So if you can all take a couple of seconds to answer this question: how are the outcomes of COP25 impacting your organization's allocation of resource to climate action in 2020? So are you increasing your resource for climate action? Are you reducing it? Does it have no impact because COP25 doesn't the outcomes don't influence you, or do you not know yet? So if we've given everyone a few seconds to respond to that, we'll take a quick look at the results before Jonathan begins. So looking at that looks like quite a few people don't know yet. Quite a few people waiting, the majority sort of waiting to find out. No one's reducing, much relief to us, I'm sure to everyone on the call, no one's reducing their resource for climate action, but then pretty even in terms of no impact or increasing. So it seems a lot of it is, let's see how this is what this really means. And I hope Jonathan might be able to answer that or give you some insight into that in his presentation. So with that, Jonathan, I'll hand over to you.
Rebecca, thanks very much. Hello, everybody. Being called a veteran of COPs is, I have mixed feelings about that. But what I'm going to do today, as I've done for the past number of years, is give some reflections on what happened in Madrid. And of course, Madrid should have been Santiago in Chile. And things moved from Chile to Spain a month before the event. And actually that went very well, but the outcomes less so. But when we dive into COPs, and we've all got that in our mind, sometimes it's useful just to remember the context of that. So COPs stand for Conference of the Parties to the United Nations Framework Convention for Climate Change. That framework convention set up the Kyoto Protocol in 1997, and it came into force in 2005 and was supposed to carry on until the end of 2012. And you'll probably also remember that the COP in Copenhagen in 2009 failed to develop and agree a successor agreement to Kyoto, so the ball got sort of kicked down the road a bit. The COP in Doha in 2012 extended the Kyoto Protocol for another 8 years and gave us an opportunity to meet up at the COP in Paris in 2015, which did successfully unite all nations under the UN Framework Convention for Climate Change into a 16-page agreement, which was the Paris Agreement. And then over the past 4 years, effectively what's been going on is that we've been trying to translate that 16-page agreement into a rule book so that when we get to the 1st of January 2021, we can really kick off with the Paris Agreement, successor to the Kyoto Protocol. One thing I want to mention is that the Kyoto Protocol extension from 2013 to 2020 hasn't been ratified. So we've been wandering through the wilderness, and there was great hope actually that, you know, in Madrid, we'd sort of bring it all to a point and really get everything ready. So today, that's my first point on the agenda. Quick contextual placing of Madrid, COP25. I'm now going to talk about what happened in Madrid, and as Rebecca mentioned, the implications for business, which is really the part we want to focus on. This diagram, this picture, was the one that I used in 2016 when we had a webinar and had various client meetings to explain what really happened in Paris. This remarkable thing, all countries joined up into this amazing formation that had every country agree to set its targets through a nationally determined contribution statement and to start implementing those NDCs from 2021. And a lot of that agreement was voluntary, except for the requirement to set an NDC and to report progress against that. There were no fixed rules or targets imposed on countries. The initial NDCs got gathered together, and what we found through analysis is that combined aggregated NDCs weren't really going to get us anywhere below 3 degrees Celsius, and so there was an ambition gap. So the great expectation for Madrid was a commitment of all of these brave countries that have jumped out into the unknown to tighten up their NDCs so that we could really have a controlled flight to a stable climate by 2050. The second thing, well, actually the main thing that was the focus of Madrid was Article 6 of that 16-page agreement that I mentioned, which dealt with collaboration amongst these countries. Here in this picture, it looks like everybody's holding hands and getting on really well. But Article 6 was all about how different countries could collaborate, because the opportunities to mitigate climate are unevenly spread around the globe. And so collaboration, finance flows, technology flows, innovation, really key to making this work. So the hope was that we'd get enhanced ambition, everybody tightening up their NDCs before we enter into the Paris era. Those initial NDCs were more putty-like. Some were defined in 5-year stretches, some in 10-year stretches, some in points, and some covered all of the economies and very few, and some just parts of their economy. So the goal was really to turn that putty into Lego blocks that really built a solid foundation and framework for action. And that was the integrity of accounting, and then finance for mitigation, adaptation, loss and damage. So mitigation is obviously reducing emissions, adaptation to changing climate, and for small island states and low-lying countries like Bangladesh, you know, an expectation that if we're all going to pull our weight here, we'd need some funding for loss and damage. One of the successes of Paris was because developing countries were led to believe that there would be finance available for their transformation and transition to low carbon economies. And this piece of finance, there was a big hole in the funds across all of those items. And so the view was that we would try and fill that. And then the collaboration piece really speaks back to the Article 6. So now that we're 2020, I'm shifting away from all of those countries jumping out of the aeroplane. I'm going to ask you to imagine that sort of balsa wood aeroplane that some of you might have played with in your youth. I'm old enough to recall these balsa wood planes that you would wind up an elastic band and then throw up, and you know, they'd fly. And for me, the Paris Agreement and what happened at Madrid sort of, you know, this is quite a good analogy, because while some countries that had leapt out of that plane were trying to wind up the elastic band to give enough VUMA to get this thing airborne, others were unwinding it through lack of ambition, issues that were debated about, you know, transferring Kyoto era instruments into the Paris era and a whole range of things. So while some countries were winding it up at the front, it was sort of being unwound at the back. And then when it comes to the finance thing, of course, everybody looks at this agreement and says, wow, we're going to be building an international carbon market, we're going to be doing all these things. So why don't we use the collaborative framework to raise money? Why don't we put a little tax or a premium on instruments or mitigation outcomes that get traded and transacted between countries? So, the image in my mind is you've got this aeroplane waiting on the runway to take off, and everybody's sort of putting their baggage into the hold, and there isn't really much energy to sort of get momentum to get this thing moving, let alone airborne, as everybody's expectations for ambition, overall mitigation of global emissions. So in other words, not just sort of aiming for net zero, but going beyond. Everybody's expectations got piled on to this poor old aeroplane, and means that progress was slow. So just running down the points on the right-hand side of that diagram, and there was no commitment to revise the NDCs before 2021. So we know that we go into the Paris era without a set of building blocks to deliver less than 2 and hopefully 1.5 degree limit to global warming. The integrity of accounting, all of these mechanisms of turning putty into blocks that can be added up and linked together. There was no clarity around the frameworks for measuring and reporting. Finance got nowhere. Green Climate Fund, which is supposed to have 100 billion in it by the end of this year to help developing economies address their mitigation efforts. What we found there is that that 100 billion that's supposed to be raised this year, over the last 6 years, the fund managed to raise 20 billion and has managed to disperse 1.5 billion. You put that in the context of, some of the bailouts that were done in the financial crisis. You can see this is a really small amount of money to bring the developing world up to speed. The adaptation fund, which was going to be funded by the transaction of CERs under the CDM, so managed to raise about 90 million from 11 countries in 2019. So really inadequate to the task, and the whole loss and damage didn't even get to the money part of that. So big hole there, a big disappointment. And then the collaboration, Article 6, of which there are 2 key sub-articles, 6.2, which talks about how countries can fund mitigation outcomes in one country and use them to meet their own targets. But we need proper accounting to make sure things aren't double counted. So Article 6 has this concept called ITMOs, internationally transferred mitigation outcomes. And the definition of that didn't really make much speed, but actually that's the part of Article 6 that is in better shape. 6.4 is to replicate and improve on the clean development mechanism of the Kyoto Protocol, which was very successful in the early days when there was ambition in driving finance to developing economies. Very little progress on that at all. So, but that's sort of a political view, sort of using politics as a lens to see what we did. Let's, if we move on and take a sort of business perspective on this. A little bit of background to this slide, actually. In the lead up to the COP, not last year, the year before, in Katowice in Poland, at that stage, the presidency of the UNFCCC of the COPs was with Fiji. And they had this idea of running Talanoa dialogues to try and bring some momentum and agreement and break down the brinkmanship that has always characterized these negotiations through these Talanoa dialogues, where people would get together and ask 3 simple questions. Where are we, where we're trying to get to, and how are we going to get there? We used that as an opportunity to bring the voice of private sector, and particularly our clients, to the UNFCCC process by holding 7 events with 61 companies and asking those questions. And we assembled all of the outputs from those and wrote a final report which we submitted to the UNFCCC as requested. And there were 10 findings in that. And actually what I'm going to do now is just use those 10, I shouldn't say findings, recommendations, sort of test how well we're doing. So in our Talanoa Dialogue final report, we broke out recommendations that we heard across those 7 meetings into finance, accounting, and finance for net zero, accounting for net zero, and enhancing net zero. So we focused it very much on the private sector's contribution toward net zero. So the red items are those where very, very little progress was made, and the black ones, and I'm being generous here, would be where some movement occurred. So operationalizing Article 6, of course, I've already mentioned. Accounting for fossil fuel subsidies, that was something that came up. People said, you know, these NDCs should also declare some of the counterfactuals, countervailing initiatives, and make them very transparent, and show how subsidies for fossil fuels would be reduced in a country's plans. Fund and empower the Green Climate Fund, I've mentioned. We're not really near to that goal. Evolving the NDCs to blueprints for net zero. So at the moment, the NDCs are just targets, and this group of companies said, you know, one of the things that has been helpful to business is the goal of net zero, because it's so understandable as opposed to keeping temperatures below 1.5. That's difficult for a company to take on, but net zero through carbon neutrality is. So there was a view that the NDC should actually be evolved into blueprints for net zero, and translating net zero into carbon budgets. You know, we've organizations like Carbon Track have done a great job in figuring out how much we can continue to emit before we breach the safety zone and go above 1.5 or 2 degrees. And so translating net zero into carbon budgets for countries, for sectors, was a strong recommendation. Encouraging sectoral initiatives for net zero. Now, actually, at Madrid, there were some sectoral approaches. There's something called the Climate Action Pathways, which was a UNFCCC invitation to private sector to develop sectoral plans. So some work was done on that. And obviously everybody knows that the aviation sector has got their plans for carbon neutral growth, and certain other sectors are beginning to think along those terms, because really, as we all know, greenhouse gas emissions are driven by industry and trade rather than by national borders. So, so that was an interesting development. Embrace innovative new technologies. There were a lot of side events on the side talking about, you know, blockchain, electric vehicles, a whole range of technologies that could really transform the speed and impact of what we're doing, but they weren't really at the center of the negotiations. And then when we get into the enhanced net zero, the companies really express net zero, not at the moment, you know, we've got net zero as a target. That's how the Paris Agreement sort of presents it. But for business, this is an inflection point where risk becomes opportunity, and where we control rather than are controlled by or impacted by climate change. And that was a very strong theme that gets talked about a lot in the side events and on the side of COPs, but doesn't seem to make its way into the negotiated text. And then build on the Talanoa dialogue. I would say I was in Madrid as a member of the IETA delegation, the International Emissions Trading Association, and I did find that the voice of business and the views of business were listened to. IETA has been had a presence at the COPs for many, many years. And there is a sense that while the Talanoa Dialogue Initiative had come to an end, it has sort of broken up the concrete a little bit, and there is better negotiation or better dialogue amongst three constituent parties. And talking of that, if we could go to the next slide. So the whole thing about Madrid was, you know, how much of that talk, T-A-L-K, is turning into talk, T-O-R-Q-E, which is, you know, force and impact and momentum. And, you know, what we know is that there are three major constituencies, and I'm sticking to my airplane analogy here. And this is a three-blade prop where business, government, and civil society are represented. And basically, business, any one of these constituencies can only do so much on their own. It really needs some balance and alignment amongst these three blades to really get progress. And also you need leverage. So if we just look at the moment, I would propose, my thesis is that business is in the ascendancy. There's more action happening, particularly in the beyond compliance, ambition, financing for mitigation and adaptation and innovation brings speed and impact. I would say that at the moment, if you look around us, you see the commitments to net zero carbon neutrality in the aviation sector across businesses. We know, we did a little research last year which showed that about a quarter of the Fortune Global 500 have made commitments to be or aim to be by 2030 carbon neutral through a combination of things like science-based targets for internal reductions, combined with commitments to 100% renewable energy and then compensation or offsetting for the remaining markets. So the voluntary piece is small, but has quite a lot of leverage and visibility at the moment. Compliance under the EU ETS, for example, emission trading schemes around the world in California, Quebec, Korea are beginning to bite. Some of the carbon pricing mechanisms on coal are beginning to see a shift from coal into gas and renewables, but really we don't have a lot of talk, T-O-R-Q-E, in the compliance regime yet. Civil society, of course, we've seen an amazing rise in activism, and that has a lot of leverage. It was very, very visible in Madrid. 500,000 people marched and various groups campaigned within the halls of COP. So they've got a little leverage, but I think that the evidence we're seeing of actual climate change is changing consumer behavior. I think not with as much leverage as the activists at the moment, but we can see that is strengthening. And then of course government, I've spent a lot of time talking about the international piece of this, but subnationals, cities, states, for example, the Americas Pledge reported that outside of the UN, current US administration's declared desire to exit the Paris Agreement, 70%, somewhere around 70% of US GDP is generated by cities, states, and others that are signed up to the Americas Pledge and are making, amazing progress. So, at the subnational level, there is a lot going on. But my final remark on this is that COP25 really failed to bring alignment and balance across these three critical constituencies. And so it's a rough, grinding, turbulent ride. And then just, my final slide to sort of wrap this up, that might have sounded somewhat bleak, but there are some surprising counterintuitive positives for business. It was clear Perry O'Neill, who is the UK is going to be president of the next COP26 in Glasgow in November of this year, and Claire O'Neill is the climate ambassador, as it were, the president of the COP. And she was the one who sort of said, listen, no deal is better than a bad deal. We saw that with Kyoto. We had many flaws in Kyoto, and it's taken a long time to iron those crinkles out. As far as Article 6 is concerned, the sort of global collaboration, sources of funding, it's absolutely critical. I mentioned IETA and the Maryland University have done some research which says that with a well-functioning Article 6, hopefully we get it in Glasgow, we could generate cost efficiencies of about $250 million per year by 2030, which would deliver, if invested in mitigation, 5 gigatons of additional reductions. If you include nature-based solutions in that, the numbers are even better, 320 billion per year and 9 billion tons of mitigation. So that evidence base is being listened to and is beginning to influence and make people realize that collaboration is really key and international markets are really key. And then the other thing I would say, third bullet point there, is business action ahead of policy informs better policy and maintains momentum, builds capacity. So there's nothing about the fact that Article 6 hasn't been written into the rule book that stops countries from forming little groups, and there were a couple announced in Madrid, the Santiago Declaration of countries committed to high integrity in market-based approaches. You know, so countries can form clubs, corporates can carry on, and in doing so, those pilots and that experience can inform a better structure for Article 6. And then the final point is that alignment with net zero through neutrality, as I mentioned, our sort of Fortune Global 500, is really driving deeper transformation and higher ambition. And one of the things we got involved in, we supported IETA in making a net zero award to the country that we felt had made the most contribution to, or the best, provided the best platform for private sector business engagement in delivering net zero and carbon neutrality. And we awarded that to the United Kingdom, not because Claire Perry is going to be the president, but because the UK for many years has had Climate Change Committee, was the first off the blocks to set a net zero target for 2050 and legislate for that. So for a variety of reasons, we and IETA made that award to the UK. And then for you as business participants in this, you know, in this turbulent times, we are in the process now of finalizing the 2020 version of the carbon neutral protocol, so that businesses' appetite to take action ahead of rather sluggish policy, international policy, have the opportunity to do so in a way that has integrity, that is understood, and that has business impact. And so carbon neutrality, and what we're trying to do is strengthen the case, the correlation we find between companies that have made commitments to carbon neutrality and deeper transformation of their business models. We're trying to make sure that that in 2020 continues to deepen and strengthen. I'll stop there.
Thank you, Jonathan. That was a whistle-stop tour through a complex set of challenges. We've had a few questions, so we've only got a couple of minutes, but I'm going to try and get through as many as I can. Firstly, you mentioned COP26 in Glasgow. Do you think that that will deliver what we need for Article 6 to fully function?
I think the odds are on. I think that the UK, for a variety of reasons, is really going to work incredibly hard to get that in place. You know, the failure of Madrid was 10 years after the failure in Copenhagen to get that. So we're due for a good, strong run. I think there's going to be an enormous amount of work and focus on this against all of those issues: finance, ambition, collaboration, and accounting. That's a hell of an agenda to deliver against. But I am optimistic. I mean, the UK, across all of the political parties, has a commitment to the Paris Agreement, to net zero. It's in legislation. They're in a great place to lead this.
So that leads nicely on to the next question. So the UK you see as, you know, really a very powerful force in making this happen. What other countries would you put up there with the UK in terms of being particularly positive and influential in a positive way in this area?
Well, I can sort of use this as a crib sheet. You know, we asked a number of market experts to vote on. By the way, we didn't select the UK. We got people, I think 13 people voted on that. And the other runners up were Costa Rica, because they've made commitments to carbon neutrality for many years. They didn't knock UK off the perch because they haven't really made it easy for business to latch into that. Norway was another. Switzerland with its pilots, you know, irrespective of where we are on Article 6, they are running pilots to test international collaboration. So there are a couple of others that would sort of join that group of leaders. Costa Rica, Switzerland, Norway had been sort of called out.
And final question, we've got 1 minute, so it's a complex question that you've got 1 minute to answer, but what do you think the lack of a decision on Article 6 means for voluntary action, you know, at the moment, right now?
Well, I think it puts an enormous load on the voluntary market to continue to maintain capacity and innovation and leadership in this collaborative dimension. Some questions came up in Madrid about whether the voluntary market can operate without all of the rules that apply to countries. And the answer to that, we know, is of course they can, because when a corporate funds a mitigation outcome in a country, they don't export it back to their, where their headquarters is domiciled. So actually the voluntary market has a terrific opportunity to continue to innovate, hold this together, create the building blocks for a truly international market, and in the meantime, direct funding to projects that are really going to make a difference in the developing countries that have been somewhat shortchanged. And also sort of provide the models for Article 6 as that sort of comes into being.
That was stunningly good timing, Jonathan. You finished right on 4:30. So with that, I'm going to say thank you very much to you, Jonathan, for this, and thank you very much to all of our attendees. We had a lot of people on this webinar, which I think indicates how interesting it is to everyone. And we will be following up with a link to the webinar that you can use to review again or share with your colleagues. And we thank you all very much for attending and wish everyone a healthy, happy 2020.